Hey, Dan Passarelli here. Today I want to talk about something called pin risk and how we manage that. I've got a message this morning from one of our traders who had on a position in the IWM 220 puts that were expiring today. Now, the stock was really close to the strike price throughout the entire day. He was short some cash secured puts. Now, when you're short cash secured puts, you could have the objective of letting them get assigned, therefore owning the shares, and maybe doing the recycle trade in which you then sell a covered call. Or your objective could be to try and skate on those puts and to not have a position and just end up keeping the premium you sold the puts for. But what can happen is if you're at expiration day and the stock is very close to the strike price, you have a situation where it's unknown to you whether the stock will be above or below the strike price, and therefore whether or not those puts will be in the money or at the money at expiration. That means on Monday morning, like if the stock closed exactly at the strike price, those puts may or may not be assigned because the person who's long those puts has the choice. They're called options. They have the option of exercising them or not. And you being the short, you don't know if it'll be exercised or not. And so you don't know if you'll have long stock Monday morning or if you'll have no position Monday morning. Now, those sort of unknowns are really unfavorable for option traders. So when the stock is right at the strike price, you have a special kind of risk called pin risk. And pin risk is simply defined as not knowing whether or not you will be assigned on a short option position. It's when the stock is right at the money on expiration. What are a couple of ways that we can deal with this situation? Well, first of all, we want to identify when is it most likely that a stock will be pinned to the strike. And that has a lot to do with open interest. The more options that have been created at that strike price, the more likely it is that the stock will be pinned to that strike. Because a lot of times, the reason why there's so much open interest is that people sold covered calls or cash secured puts already, and that means the market makers are long them. And when market makers are long a lot of at the money options on expiration, that's where their hedges tend to force the stock to get pinned to that strike. So here we look, and on the call side, there's 8,222 open interest, and on the put side, there's 6,883 open interest. We have to look at both the call and the put because market makers don't care if they're trading calls or puts. They look at them all sort of as synthetic straddles in their gamma scalping strategy. So because this has a bit of a high open interest, we can think, yeah, there's a reasonably good chance that this stock will be pinned, so I have to do something. The easiest thing that you can do is to simply buy to cover. Buy back those short options before expiration so that you don't end up in that situation. Then you can always roll out to another expiration, sell those puts again, sell them at a different strike price, or just choose to do nothing. That puts you in control of the situation. No unknowns coming in Monday morning of will I have long stock or will I have no stock. It puts you in control. And you're going to be in a situation like this only if you're profitable. And so therefore you'll be taking the bulk of your profits, you'll be doing your rolls, doing your adjustments, or simply getting out of the trade. This is Dan Passarelli with Market Taker Mentoring. Trade well. We'll see you next time.